we got to talk about what all of the economic implications are. And in your note to us, you point out the big debate right now, and this is a debate that we have been having frequently on the show, is inflation coming or is inflation not coming? And then what are the implications of that, the answer to that question? Jim, where do you come out in this debate?
So I think it's an important question. First of all, thank you for having me on your show again. It's a pleasure to be here. Look, I think the markets can be divided that way. It's as simple as that. Do you believe inflation is going to be a problem in the very near term, or do you think that it's something that you don't have to worry about and the Fed can take care of that, later on as they need to? And where I come down on this is I continue to look at the output gap that we have, meaning that the degree of growth that we have fallen below potential. So if potential growth's up here, we're traveling somewhere down here. We've got to close that gap, and that's called the output gap. This is something that Jerome Powell at the Fed and also Janet Yellen at the Treasury have discussed and talked about. And the idea is that you need to close it very, very quickly. Otherwise, excesses start to build up in the economy. The unemployment rate would go up. Credit quality would deteriorate, and that would just short circuit any type of recovery. So when you have this big excess capacity, and that's what the output gap measures, it's hard to generate a lot of inflation because you have spare capacity. But I know the debate starts to go into, well, we also have a large stimulus. Well, money supply is also growing. All of those things are true, but I think that all of those things are something that happen down the road. Because what we have to remember is that inflation is something that happens year over year over year. Inflation's a growth rate, right? It's not just a one-time shock. So could there be some a lot of demand that comes into the economy and pushes prices up initially. And yes, that can certainly happen. But will it be continuous and sustained given that we have this spare capacity in the economy? And I think, look, there are very smart economists on both sides of this. And some are saying that the stimulus packages are too big and that we're doing too much. Others are saying, I'd rather be too big than too small. Let's close the output gap and worry about the details later. And I think the market has to pick sides. And where the market's choosing right now is that it would prefer to close the output gap sooner, worry about inflation later. And I think you're seeing that in financial asset prices right now.
Jim, I had a guest on yesterday, and he said to be on the lookout for potentially high single-digit GDP growth in the second and third quarters of this year. As more people get vaccinated, they go out there and spend. Should that happen, where is the 10-year yield?
Yeah, I'd even up the ante on that. I'd say be on the lookout for low double-digit, growth in maybe the second or the third quarter. So look, 10-year yields are part of a broader process, right? So I always think about 10-year yields in context with financial conditions. Financial conditions are really a way to say, where should 10-year yields be with respect to what credit spreads are doing, what equity is doing, what currency is doing, and other things of that nature. So if we are going to have very strong economic growth in the second quarter and people have high single digit, low double digit expectations for that, and also you're going to get you're going to get a stimulus check, right? So remember the retail sales number that came out last week based on a much stronger than expected retail sales number, that caused people to really ramp up even their first quarter GDP numbers into like 5-6%, some even a little bit higher, than that. So in the context of strong growth, hopefully the vaccines being rolled out, the reopening of the economy, incomes, people getting hired back into the labor force, and the labor force should start to grow on average around 200,000 to 300,000 jobs per month on average, right? Going forward, that should replace a lot of that should create a lot of income, a lot of pent up demand. I would argue that the range for 10-year treasuries could be between 1.5% and 2%. If it's on the slower side, 1.5 seems about reasonable. We're at 1.45% today. But if we have this really, really strong double-digit growth in the second quarter and very strong growth in the third quarter, I wouldn't be surprised to see 10-year treasuries up around 1.75%, maybe even a little bit higher than that.
Jim, a question I am sure you are getting is questions about taper tantrum 2.0. How are you talking through those kinds of questions and explaining to clients who are concerned just how much different this kind of episode is in the bond market?
That's a great question. So 2013, everybody's got it tattooed on their brains. We're all scarred, from that. And I know I am. It's just very traumatic. Look, the initial conditions for a taper tantrum that existed in 2013 are very, very different than where we are today. 2013, we had already been going through the global financial crisis several years after. There was a big recovery in place. Fed policy was low, and the Fed was interest rates were low, and the Fed was willing to start to hike interest rates very, very quickly, and that's what spooked the markets as the Fed started to talk about tapering, and the market said, well, this isn't going to be a slow process, this is going to be fast, and everybody got very, very nervous. This time around, the Fed is saying something very, very different. The Fed, number one, has a flexible average inflation targeting. So in other words, they're not worried about if just getting to 2%. They're willing to overshoot a 2% in inflation target. The second is that you do have this large output gap right now that exists. This is like post World War II level styled output gap, this shortfall in or this excess capacity that we have. So the ability for the Fed, or the desire, even when we heard Powell speak this week, for the Fed to actually hike interest rates very aggressively is very, very low, according to what he's saying. And also the balance sheet is what he's talking about in terms of reducing some of the asset purchases. This may be somewhere down the road, very, very slow. And he also wants to promote, what we also have to remember about the Fed too, what's also very, very different, is that the Fed is trying to also promote equity and equality with their policy. This is a very, very key distinction versus what has been going on in history. So in order to do that, one of the Fed's goals is to get to full employment. And effectively, when you look at the demographics of the lower income and wage earners, they tend to do well later in the cycle, because they don't own stocks, so they can't participate in the early cycle movement higher in stocks and things like that. It's mostly about wages and incomes and job security and things like that. To the extent that you don't have an inflation risk or fear based on what the Fed is telling us, then their ability to keep rates lower for longer and policy very accommodative for an extended period of time is much more part of their policy reaction function today versus where it was in 2013 when we thought that, well, they're going to just start hiking very, very quickly and that's going to upset the bond markets. I don't think that's where we are today. I think policy is very different. Plus technology and everything else has kept prices, inflation in check as well. So I'm not saying inflation is not a risk and it's not a problem. It's not something that we should, of course we should worry about it for sure. But at this current juncture, I don't see it as immediate problem.